Now, structured flow-through shares create a 25% or more profit. Here's a proven strategy that will help you earn a 25% or more profit just by filing a different tax return. We harness the tax benefits of flow-through shares while removing the usual stock market volatility. Let's start with the basics. Flow-through shares are unique under the Canadian tax law. First created in the 1950s, these shares are issued by early-stage mining companies to help raise capital for exploration in Canada's north. In return, for every dollar you buy of these flow-through shares, you receive a 100% tax deduction, just like your RSP. Why? The government relies on high-tax Canadians to help fund Canadian resource development, and in particular, exploration for critical minerals needed for technology innovation in our clean energy future. And in return, the government rewards you with a substantial tax break. There are three key players in this transaction. Think of it as a three-legged stool. You have the investor, the mining exploration company issuing flow-through shares, and a liquidity provider, usually a fund or institution willing to buy the shares from you immediately at a discount. Remember, this is a structured transaction in which all commitments are negotiated in advance, so you know the outcome before the transaction takes place. No surprises and no stock market risk. Let's use a simple example to make this real. Suppose you buy $1.50 in flow-through shares. Just like an RSP deposit, you get to write off the full amount, saving 75 cents in taxes based on a 50% tax rate. On top of that, depending on where you live, you receive additional provincial credits and either a 15% precious metals federal tax credit or a 30% critical mineral tax credit if the project qualifies. Now, here's where the strategy shines. Right after you buy the shares, you sell them to a liquidity provider at a prearranged discount price, let's say $1. This happens instantly, so there's no risk of the price dropping or the shares being hard to sell. The liquidity provider takes on all the stock market risk. Now you have $1 in cash and 75 cents in tax savings. Right away, you just earned a 25-cent profit with the $1.50 float purchase. And with additional credits and deductions, your return, depending on the province, could be higher. Think of it as an additional tax savings tool after you've maxed out your RRSP, TFSA, and other tax reduction vehicles. There is also the option to not keep that dollar from the liquidity provider, but donate it to your charities, unlocking a 50% tax savings. In doing so, you can grind down your cost to donate from the 50 cents to give $1 standard at the highest marginal tax rate to as low as a penny cost. Now let's be clear, flow-through shares are not a tax loophole. In fact, they are the exact opposite. Flow-through is a long-established tax policy. The government is encouraging high-tax Canadians to participate. Since 2007, structured flow shares have generated billions in financing for exploration projects, creating jobs, and the process had a major impact on employment in our economy. Meanwhile, for those that are philanthropic, this model has created over $1 billion in donations for charities all across Canada. The structured flow-through share model has received no less than 9 advanced tax rulings and is trusted by accountants, wealth managers, and charities all across Canada. Every step in the process is handled securely and in full compliance with all regulations. Most importantly, there are no surprises. So who qualifies for this structure? Well, you must be a Canadian taxpayer, corporation, or trust, and you should have a personable taxable income higher than $200,000 and corporate income at top marginal rates. Interested in learning more? Our team specializes in working with you or your accountant to create the best possible outcome. I'm Peter Nicholson, President and founder of Wealth.